Welcome, everybody. I want to welcome you to our presentation today on the Simple Numbers Profit Tool. Today we're going to be hearing from Greg Crabtree. Greg is a client of ours, and we got talking about the Simple Numbers Tool, I guess it was a few months ago, and I wanted to present it to our database of clients and prospects because so often we hear people they want, well, really two reasons. So often I hear people looking for a dashboard of key indicators. You know, how can I get through this plethora of information and find out what are the key numbers that matter to me to run my business? And the Simple Numbers Profit Tool is just that. It's this excellent dashboard where you can get some very key financial numbers, 7 key numbers that you really need to be paying attention to as you begin to scale your business. It really doesn't matter how much revenue you're generated. The magic number here is profit. If you're not generating profit, then you don't have a saleable, scalable business. I've seen businesses that are doing, you know, $10, $12 million in sales, and they don't have enough money to pay their taxes, or they don't have enough money to make payroll. And it's just a waste of your time to be doing that. So this is a great, great tool to put these 7 key indicators in front of you. Additionally, a lot of business owners get puzzled by their QuickBooks data. They're looking at all this confluence of content coming to them, and they're just sort of, they don't know what to look for. They don't know how to read it, and it's almost always like they're reading it in hindsight. So, and which is the metaphor I like to use is it's they're looking at their business. It's like driving a car, looking in your rearview mirror. It's all what's been going on behind you. And the Simple Profits Number Tool really brings all of that content forward in a dynamic way. And so I've invited Greg to speak to that today and to show you this great tool that plugs into your QuickBooks data and presents this content to you in a dashboard format. And it's dynamic, it's live. What's going to happen today is Greg's going to speak to you with a slide deck for about 25 minutes, and then he's going to flip over and actually show you the tool. I want to encourage you to stay here for this presentation because there's a free trial of the Simple Numbers Profit Tool, and because you're registered for this presentation, Greg has given you a discount so that you can get this tool at a discount. And for those of you who have Touchstone accounts, at the very end, I'm going to show you how you can go into the Touchstone General Process Library and access a procedure that we've done together with Mike's company to be able to access the tool, to map your QuickBooks to the tool. There's all sorts of great work plans and processes there to help you implement the tool. And for those of you who do not have a Touchstone account, there is going to be a link at the end when we get into the question and answer period where you can actually log in and access the tool. And anybody on the presentation today who's registered also can register for a new Touchstone account for a free month. That's one of the other things that we'll give you just for registering today. So that said, I want to introduce Greg. Greg is a speaker, he's an entrepreneur, he's a financial expert. He used his entrepreneurial skills to develop his company called Crabtree, Rowe and Berger. They're a chartered accountants, a CPA firm. Their dedication is really to helping entrepreneurs build the economic engine of their business. It's not just about taxes, it's about scaling and growing this economic engine. Greg is also an author. He wrote a book called The Simple Numbers Straight Talk Big Profits, where he's really sharing his core principles of how to run your business and how to turn it into a wealth building engine. And Greg, hopefully you've got a place where they can get that book online. So I am going to turn it over to you, Greg. Hold a second here. I'm going to make you the presenter.
All right.
Show my screen.
Good.
Okay, so
Right.
Great. It's over to you, Greg. Take it away.
All right, I appreciate it. And so appreciate that, Michael, and we're huge fans of your product as well. It's something that we recommend to our clients, and we found it extremely useful to us, so love to give the shout out to that, because it's certainly one of those things that the businesses that are great in dividing processes to make sure things work on a predictable pattern, those really help. So, let me kind of get right into it. I mean, if you look at this word cloud slide, this is really what most people see accounting. It's a big jumbled mess of words and things that don't make sense, and we call this the accountant's apology. And I did a presentation not too long ago to a group of entrepreneurs, and I said, well, I'm here to apologize for my profession, because we've made this a lot harder than it needs to be. And unfortunately, what we've done as the accountants is, everybody that's on this call, if I had all of you pull out your P&L and we showed them all on a screen, you would have a different version, a different view, a different subtotals, different line items on every single one of them. And what we've done is we've created the Tower of Babel for accounting and financial knowledge. We've got to speak one language. And so I took on this project to look at it and say, how do we fix this problem? And even though it's not a billable hour, I started doing research on our own client data, because I'm sitting on hundreds of businesses' intimate details. And even though I can't share the specifics, with those, because that's confidential information, it is data that I can research and create ideas and concepts and learn from. And as I went through, it struck me that there's some key things, that we really believe that changes. These three items are really the big keys that we learned from that research project. The first thing is we have to remove distortions. And you have to say, one, what are the things that you're doing to your data that's causing that number to not be the truth? Two, you've got to present the data in a common format that allows for readability and understanding. And so I'll show you those concepts, and those are things that we built into our model. And then secondly, the second big key is, now that you've cleared the distortions and we have a common language of talking about the data, the key to improving profitability is labor productivity. It's second to none by miles and miles, in terms of it is the companies who get the most productivity in dollar production for every dollar of labor spent, both in direct labor and management labor. Those are the companies that win. And then once you create a company that's profitable, then you deal with what we call the four forces of cash flow. What's the strategy of using the cash that is generated out of that business to make the appropriate sequencing of decisions? All decisions are good at the right time, but a good decision at the wrong time is a bad decision. And what we try to do is give people that sequence of going, here's the prioritization of what you have to knock down as the straw man, to get to then finally harvesting the profitability off of the business. So the first key, let's kind of touch on a couple of these distortions. The most common distortion is owner compensation. And so, normally I'll go into these in greater detail, and maybe we'll come back and do a longer presentation at a later date. But ultimately, S corporation owners are trying to save payroll taxes. Yeah, it is real money, but what we find is incredible results when we get people to quit trying to think about payroll taxes and start making profit. We've got enormous turnaround situations of clients that quit trying to play the games and just focus on running a business the right way. The other is multi-owner businesses, where you've got shareholders who are being paid the same wage even though they don't have the same job. And that's confusing ownership with the job that you have. And so the phrase that I'm known for in the entrepreneur circles that I speak to is, you get paid a salary for what you do, you get a return on what you own. Don't confuse the two. And we think this is a huge issue if any of you are multi-shareholder businesses. If you're in the startup mode, or you're going through periods of thin capitalization, certainly sweat equity is something that needs to be accounted for. Or if you're an LLC, people don't understand this way of actually doing guaranteed payments as a salary replacement inside an LLC. We see in a lot of professions-oriented businesses, doctors, lawyers, accountants, architects, so forth, they do the leftovers mine business strategy where, oh, well, here's what I paid in all my expenses, and what's left over is what I'm worth. And I go, no, your services are worth X, and your business is returning Y. Let's don't mix those two things together. And really, the thing that we try to convince people of is, yes, as an owner, you get to pick any job in the business you want, but the market picks your pay. And we've had significant examples where, I tell a story in my presentations of a dentist that, wanted to be compensated by his partner more for running the business. And I said, that's great. We'll keep up with all the time that you spend running the business, but we'll compensate you at $75,000 a year for the hours that you spend managing the business. But as a dentist, if you got your hands in somebody's mouth, you can make somewhere between a low of $300 and $700. So you pick any job you want, but the market is only going to pay you what it's worth. And if you overpay yourself for that job, you're just stealing it from the bottom line. So we think these are huge, huge issues. So once you get down to truth out of the financials, now we've got a way to start talking about it. And so one of the common language things is people talks about EBITDA. We don't like EBITDA. EBITDA is this contrived term that MBAs on Wall Street use for trading publicly traded companies and a few of the bigger venture firms that are trading privately held businesses. It's just a flip technique that is not really to be used for managing a business to get it profitable. It's typically a term that's largely used only in an exit or sale of the business. We want you to focus on pre-tax profits. And think of it like this. If you went out and spent $500,000 to invest in a CD, the interest that you get off of that CD or bond is, that's your return on investment. I want you to think about your business in exactly the same way. And so if you go invest $500,000 of capital into your business, how much profit did it generate based on the capital that you have? Keep in mind, though, as a privately held business, capital is formed in multiple ways. You can either put your money in, which most of you didn't do, or you can retain profits after you've paid the tax implications of it. That's the more likely way of doing it, or you can attract an outside investor. Debt is not capital. And I'm on a one-man mission to forever convince people that you never use the word capital when you're referring to debt, because it is not debt. It demands, it has terms for repayment, and it's not there for you to use as capital. So that's the key, is focus on those pre-tax profits. Most people think of revenue. Oh, great number. We got to focus on revenue. No. I don't want you to focus on revenue. I want you to focus on gross margin. There's tons of businesses out there that produce phenomenal amounts of revenue and no profit. That's not a business that I respect. What I respect is based on what you took in revenue from the customer minus the subcontractors or material cost or any out-of-pocket costs for your direct labor, or direct costs, not direct labor, but that gross margin, revenue minus direct costs that don't include labor. We think that's the beginning of the economic chain for your business model. And so we want to accentuate. Now, you have to start with revenue, I get that, but think of it like this. If I've got a business to where I win a project that's $100,000 and I got $80,000 of subcontractor cost, I've really got $20,000 of gross margin, versus I win another contract that's only $50,000 in revenue, but it's all done by my people. Which one's better? Well, I want the $50,000, not the $100,000. And so many businesses are structured on revenue thinking. We want to turn you into a gross margin thinker. Much even better than gross margin, though, is contribution margin. So this is a term that we had to create because we figured out in our research that one of the worst things that you can do in your financial statements is mix labor with something that's not labor. Because it really was that thing that popped out of our research, of the fact that labor is the key driver of all things that produce value in the business. And so therefore, we want to look at gross margin minus direct labor to get to the true, what we call the output of the business engine, which is contribution margin. So those are our terminologies that we want to focus on. So ultimately, we created a simplistic P&L structure that takes into account these items. So revenue, remember, revenue is a vanity number. Revenue is vanity, and profit is sanity, and cash is king. Cost of goods sold, it's not your money. Cost of goods sold is bait to get people to come to you to get that thing that they're going to pay you for, and ultimately what you have left over is gross margin, and that's what you really start with. Direct labor, as we say, don't ever mix labor with other non-labor costs. And then one of the things that we see is this bottom part in expenses. So we break down the P&L in a very simplistic structure that only uses 5 lines of data: facilities, marketing, management, labor. Optionally, there are some clients that will separate out sales labor. A lot of times we won't do that within the financials themselves. We track that on a side basis. Payroll taxes and benefits, and then other operating expenses. So those 5 items are the core, and you'll see that in the profit tool as we show you. And then you've got below the line income and expenses of interest, income, depreciation, and maybe some non-period activities. Sometimes people have special expenses in their business that we consider below the line. For example, we had a client who was in a franchise business. They broke their franchise agreement, and they had a multi-year payout for breaking that agreement to get out of the franchise. And so we considered that not an operating cost. So it is a cost that does affect net income, especially pre-tax net income, but we wanted to show it below the line. So this is an example of the P&L that you'll see in the tool, in that you can see that we show a construction company. And this is one of the best examples that's kind of a in-your-face version of the construction guy saying, I'm a $20 million business. And I go, no, you're not. You're a $2,850,000 construction services business, because that $17 million that you paid in cost of goods sold for materials and subcontractors, you take a draw against the job for the materials, so you didn't have any cash flow risk in it, and you don't pay your subcontractors until you get paid, so you don't have any cash flow risk in that. And so from that standpoint, you look at it from a gross margin down, size business. Then you can see gross margin minus direct labor gets you to the contribution margin. And this is where we introduce the concept of direct labor efficiency, because our belief is it's not about FTEs or full-time equivalent employees of how you manage labor. I don't care how many bodies I have. What I care about is for every dollar of labor that I spend, how much margin did it produce? And so in this case, you can see the direct LER number of $2.85. For every dollar of direct labor, we produce $2.85 of gross margin. And so as we start to monitor that key indicator across time, it gives us a very simple determinant that says, is my labor getting more efficient or less efficient? As that 285 rises to a 3, I go, okay, we got more gross margin for fewer labor dollars. If it declines to a 2.5, it's like, hey, either we're not delivering enough work for our people to do, and we may have to trim labor, or our people aren't getting everything out the door that they could every day. And so it becomes a very quick indicator of the productivity of labor in that regard. Then you can see the operating expenses: facilities, marketing, management, labor, payroll taxes, and benefits, and other operating expenses. Many times a lot of people will raise the question about what about the payroll taxes as they relate to direct labor. And we are not fans of allocating cost out. I think one of the wasted efforts that the accounting world does is they start fractionalizing a cost. They take it and start spreading it like peanut butter across the financial statements. And we think that really just creates more distortion than it solves. And we would rather take a bucket of cost, and like payroll taxes and benefits is a perfect example. I want to manage that as a pool, much like the way the government contracting industry looks at it, because that individual can't make any change to that payroll tax and benefit number because they're statutory payroll taxes, and then you've made contractual obligations to provide any benefits to them that goes into that bucket. And we see it as a much more effective measure to look at it as a percentage of all labor and manage it that way, rather than to take it, start spreading it out, and you lose your sense and feel, of that regard. The last item, that other operating expenses, is the catch-all of all other things. If it's not facilities, if it's not marketing, if it's not management labor, if it's not payroll taxes, it's other operating expenses. It's the item that has the greatest number of accounts in your P&L attached to it, but it's the one that actually on a rolling 12 basis moves the least. It really is not as variable as you may think. And so we see a lot of people get on the warpath of profitability and they start cutting back on kitchen supplies and toilet paper, and all you're going to do is aggravate people. There's not enough dollars in that bucket to actually cut out and make a significant change in profitability. What is significant is you either have labor that you're spending money on that's not being productive and you need to eliminate it, or you need to deliver more revenue and gross margin for your labor to work on, and you have to solve that equation. That's really what drives profitability. Over here you can also see the introduction of the term management LER. We hold management labor, that $750,000, accountable to contribution margin of $1,850,000. And so we believe this has really kind of been an interesting factor, because we believe that once we develop this management labor efficiency concept, it really has struck fear in the heart of ineffective management teams, because they now know that we can hold them accountable. And so a manager is responsible of driving contribution margin, which comes, there's three things that affect contribution margin: of revenue, cost of goods sold, and direct labor. They've got three levers that they can turn. And you can't just be myopic and drive revenue that doesn't filter down and go into contribution margin. We've seen time after time in our consulting services where we'll break down a business that has $1 million increase in revenue one year, but yet contribution margin dollars actually go down. And it's because they got focused on revenue and forgot about margin. And really, you'll notice in this example, we don't really show contribution margin percentages, because to a large degree, a percentage is an okay way to maybe do a quick forecast of something, but I'm really more focused on getting you contribution margin dollars, not percentages. I can't spend a percentage. I can only spend $1. And where people fall into a trap is they're thinking, oh, we're really highly profitable on our margin, but the problem is they've priced themselves out of the market. And so you've got to understand that business is a dynamic model, that the deeper you get into a marketplace, the margin as a percentage has a tendency to go down, and you've got to find that equation of going based on how much further I penetrate into the market. Are those dollars really sufficient, and can I hold my operating expenses constant while driving more contribution margin dollars? And we see that as a common occurrence in the businesses. Now, in this case, this construction company is a great example of looking at, if you look at the bottom of this screen, pre-tax net income of $525,000. As a percentage of $20 million, it's only 2.63%. But as a percentage of gross margin, it's 18.42. And our philosophy is when you're got this much distortion in the cost of goods sold section of your P&L, you want to manage a business like this as a percentage of gross margin, not as a percentage of revenue. Because when you show this other example that we have, is we compare this $20 million construction company to a $3.7 million services business. And once you get through the top part of the business here, you realize that they both have exactly the same gross margin dollars on a much smaller top line scale, and they look exactly the same the rest of the way down. And so this is the reason why we use this concept, because we can take all of you on this call and start at gross margin and have a very robust discussion when you organize your data in this format. So the key is, getting rid of the owner comp distortions, understanding that you can't spend percentages, it's about spending dollars. A month is a very inaccurate period of time. We're huge fans of the rolling 12 concept, and our profit tool is really designed to make it really easy for you to see rolling 12 data on a month-to-month basis, as well as rolling 6 and rolling 3s. We think those are much more higher quality data points than a month. And the thing is we also want to see people, make sure that they get cost and revenue matched in the right periods. And then we want to see that isolation of labor from things that are not labor. So ultimately, at the end of the day, or in my book, Simple Numbers, Straight Talk, Big Profits, we really push this idea that at 5% profit, you're on life support. 10% is the new break even. 15% is a great business. Anything above 15%, take it while you can get it, because the market will figure it out and they will find a way to compete. And we've seen this over and over and over again. And the only thing I will say here is these percentages are generally reflective of profit as a percentage of revenue, but if you're one of those businesses that's really just passing through a lot of cost, you may want to focus on gross margin as your true top line. Good example, we have a client that does $60 million he's an inventory distribution warehouse, and so they only make 15% on everything that goes through there. And so the idea is, I had to tell the owner, I says, well, you're really not a $60 million business, you're a $9 million inventory management business. And that's okay, because they're highly profitable on the $9 million of gross margin that they run through the business, and they're extremely efficient in terms of doing the thing that they're good at. But if he looks at his business as profit as a percentage of revenue and that turnover, he would probably quit and go home. And he's building a great business and producing great wealth, just from that understanding that he's a $9 million gross margin business, and that's what matters. So we got some action items here. I won't go through those in the interest of time. So labor productivity, touched on that one more time. Direct labor efficiency, as we said, is gross margin divided by direct labor. And we'll see that in the model as we get to that one. Ways to improve direct labor. Do you have the right people? And as you change your team and you start monitoring labor efficiency ratios, you're going to get a sense of whether or not those movements, you may feel better about it, but feeling better is not the ultimate measure of profitability. It is, do the dollars show up on your P&L? One of the things that we talk about is, are you selling the stuff that you do well? We want your management team trying to focus on improving, not just improving revenue, but improving revenue in a way that they're selling the things that you are the most efficient at. Do you have the right clients? Can management do a better job of managing your people? Are you paying them an appropriate wage? We focus highly on labor efficiency, but I'm a huge fan of paying people a market-based wage and demanding market-based performance. I think that's the right equation that entrepreneurs should be asking of their people. I'm not afraid to pay somebody a high wage if I get high performance, but I can't pay high wages and get low performance. And that's really where you won't be in business very long if you do that. Same thing about management labor. Now remember, we move management labor down to where direct labor is responsible for gross margin. Management labor has to be responsible for contribution margin. And in the book, I talk about these concepts of kind of managing like the NFL teams do, of working off of a salary cap. And so that would be an interesting concept if you like that way of essentially saying, here's the amount of labor dollars I have for this particular function, and so until I grow gross margin, I can't spend any more dollars. But understand that what a salary cap means is I can't spend any more dollars, but it doesn't mean I can't change the people. And you see that in NFL and NBA teams all the time, is those two leagues have a fixed amount of compensation that every team is held accountable to, but that doesn't mean that they don't trade players, they don't not renew contracts on some players, and they don't draft differently to get new talent in there. Your business and the way you make it productive is no different than the way the NFL and the NBA works on the salary cap concept. Unfortunately, we think business too many times works like the Major League Baseball contracts, where there's not a salary cap and you can buy your way into success. And unfortunately, what you find is teams that load themselves up with a lot of unproductive salaries, they end up going through some really dark years and sometimes die as a franchise, and your business is no different. So we got some action items here, and we'll make these slides available when Michael sends out the follow-up, so you can use these as notes as well. And so once we get you profitable, then I want to focus on these four forces of cash flow right quick. That unfortunately, these four forces of cash flow are in the exact opposite order that all of you want them to occur in. And I wish that it was different, but I would be apologizing for something that is against physics. because ultimately I know you want to pay yourself dividends and make a distribution out of your business when you have that big win and that money comes in. But unfortunately, the first thing you have to do is set aside the tax implications of what that profit is. The second thing you have to do is get off the line of credit. Lines of credit are like crack cocaine for entrepreneurs. And it's good to have a line of credit, but you want it to be at zero and only use it to grow profitably with. And we'll probably do a later session at some point. I talk about this in the book of how to use, when to appropriately use a line of credit, and it's only when you're profitable and you just need to bring what you've done from the future into the present from a cash flow standpoint. The big key is number 3, though. And this is, and we'll accentuate this in the profit tool, is we believe that this is one of the major weaknesses in businesses that we see in North America, and that businesses are undercapitalized. And so we came up with, people say, well, how much, what is capitalized? And in our research, we determined that businesses that had 2 months of operating expenses and direct labor in cash with nothing drawn on a line of credit were the most likely to stay consistently profitable and have the resources to grow when the market allows for growth. And we've seen this over and over. And at first, when I did this calculation and presented it to people that weren't at that target, they shook their head and they said, oh, that's just way too much money to have on hand. And they bought into it and did it. And where I really found out that this was true is in 2008, when everybody was struggling and lines of credit were being pulled. Our clients were calling us saying, how do we protect our cash? Because none of them lost their line of credit because they didn't have anything drawn on it. And 2008, 2009, and 2010 were 3 of the most profitable years that our clients ever had. And when I saw that, even though I had been promoting this as an idea, it really struck me as something that we had hit on, that this was a game changer. And it goes back to things that we've had clients teach us over the years. That he had one client in the plumbing supply business, and he said, I love a recession. And we're going, what? And he says, yeah. He says, this guy kept $1 million cash in his business at all times, never had a dime of debt in the business. And he said, we make the most money ever during a recession because all of our competitors go out of business. Our suppliers give us the best deals because they know that we're the only guys that can pay our bills, and life's great. And that was exactly what we saw in 08, 09, and 2010. And we've seen it continue, that even those businesses, they'll do well in times where there's great competition, and they've got very unique opportunities to be able to make maneuvers in business that people without cash don't have the ability to do. And so ultimately, core capitalization brings into this idea of a wealth-building premise from the business that you have. Assume that you got $2 million of revenue, 10% net income is $200,000. To be at the 2-month core capital target, you probably would need equity. That $400,000 represents cash, AR, fixed assets, and accounts payable, and the net of all that would be about $400,000 in most of these scenarios. Every situation that we've ever had when we've convinced a client to have 2 months of core capital, a 10% profit in the business produces a 50% return on equity. Now here's the thing, is when you have a business that is at 10% profit and you're fully capitalized and you make $200,000 net income, guess what? You actually have $200,000 of additional cash over and above what you need that you could choose to harvest out of the business, or you could choose to reinvest some of that into the business to make bets on growing your business by opening a new location, buying a piece of equipment that's expensive, hiring a new executive that's going to help you build a new territory, and you have to fund their salary for a period of time until they become effective. You name it. All of those things, to do new software development, to improve processes, pick whatever it is. But it's that company that has the cash that chooses to reinvest in the business because they know for every dollar they reinvest, I'm going to get a minimum 50%, maybe even close to 100% return on that investment, and just keep building and building and building, because the general stock market cannot give you that kind of return. But here's the key. You've got to focus on getting to at least 10% profit, because we think that's really where the healthy businesses start, and between 10 and 15 is really where the bulk of them can live. So ultimately the idea is this pyramid of running a successful business is, we've got a process where we teach people how to close their books weekly, don't wait on months, do gross margin thinking, focus on your labor efficiency ratios to get those dialed in. We've got a technique that looks at marketing efficiency to hold your marketing efforts effective, to make sure that you're not confusing activity with accomplishment, and make sure that marketing effort is producing true margin for the dollars being spent. And if you get those 4 things right, you're going to have profitability. So how do you really deal with that? So the Simple Numbers dashboard, I'll kind of show you a couple of slides on that, and then we'll go into the actual dashboard, or the actual tool itself. This is the overview page, and we believe that these 7 items, these are the ones that you really want. Now, people kind of confuse key performance indicators, and they want lots of data and dials and those kind of things, and those look cute, but at the end of the day, I want stuff that's effective. And what is it that I need to respond to? So the first thing I want to respond to is, where do we stand on profitability? So that's step number 1. And you can see in this particular example that company, they were actually red, so they're actually we're not even below 5%, they were actually below 0. In revenue, it starts the value chain, so you have to look at it and set your revenue targets. But we've added here the gross margin key, and notice we didn't put gross margin as a percentage, we put it as a dollar target, because I'm fine if your revenue is red but your gross margin is green. I'm okay with that, because that just means that you found a way to get your margin dollar target without having to sell as much stuff and pass as much stuff through. Operating expenses, I'm okay with that one being as a percentage of revenue. And then you get into direct labor efficiency ratio, management labor efficiency, and then core capital target. So this one we actually show you the actual core capital, and then we actually show you what the core capital target is. So if you're, some of you will kind of put this up there, and we'll come back to this slide, but ultimately the tool that we've designed, it works for QuickBooks desktop versions. So if you're on a QuickBooks desktop, if you're on QuickBooks for online, we're looking at developing the tool for that. We've had a lot more interest from QuickBooks Online customers than we originally anticipated, so we may consider doing an additional development. But right now, it's just for QuickBooks Desktop. If you use the discount code MILLS, you'll get a 10% discount off the monthly price, and we have a 15-day free trial. You don't have to put in your information to do the 15-day free trial, so you don't have to give payment information until you decide to buy. You can actually do this report for up to 3 QuickBooks files. So if you have multiple companies, you can actually look at each individual one. And then we also offer mapping and consulting packages that if you don't feel comfortable, I'll show you the mapping process here in a second, but we think it's pretty straightforward for you to choose which bucket that you're just moving your QuickBooks chart of account item into the bucket, based on our structure, so that you can see your data. So essentially, it's real simple. Just go to simplenumbers.me to subscribe in that process. And so these are some screenshots of the. This is the P&L, and I'll touch these here in a moment, and then also the settings page. So let me drop out of here and go on over into the tool itself. All right, so this is actually the live tool itself. So in this particular example, this company is above 5%, so they're in the yellow range. So so they had set their targets to be, at anything above 5% was yellow, and anything above 10 was green. In those situations, you can kind of slide those, and we'll go over to the slider here in a second and show you how to adjust those. Same thing for revenue, gross margin, and you can see this one was actually they're positive for core capital target, but they're short of their target by a little over $140,000. And so what you can see is the key here is when you have this kind of a scenario, you're looking at a business that's saying, if my core capital is 53 and I need to be at 191 and I'm short by 140, how do I get there? Well, the thing is you've got to retain $140,000 of after-tax profits or contribute $140,000 of capital, one of the two. But if you're a business that is producing, in this business's case, if you're at 5% profit on $3 million, you're looking at, $180,000 and roughly 40% tax rate. If this company didn't take any distributions out of the business, they would actually be to their core capital target likely within less than a 12-month period of time. So that's the thing that you're really trying to look at. If you click on the profit and loss tab, you can see that you've got choices of looking at your data rolling 12, rolling 6, rolling 3, or monthly. So let's click on the rolling 12 tab, and you can see in this case, you can scroll out here to the end. So this is all the data back to in the file. So what each month represents here is these are 12 months of data. So this is the 12 months ended June of 2014. This is the 12 months ended May of 14. One of the things that people get hung up on is they think that they're working off of January through December. And I got news for you. Every month ends a 12-month accounting period. So you really don't need to worry about a new month somewhere. And we see people set plans that are based on calendar years, and they get 3-4 months into the year, and they think, oh well, we're not going to hit it. So then you end up wasting 6-7 months of the year, working off of a bad plan. And our philosophy is, hey, every month starts the next 12-month cycle. And so if I'm off plan, let's fix the plan, fix the model, and figure out how to make profitability go forward. And that's really what our tool presentation really is useful, because it breaks that chain of looking at data, such that people think that, they only need to look at it year to date. Well, I'll tell you, I am not a fan of looking at year-to-date data, because I'm looking at less than a 12-month cycle. And we think rolling 12 is the highest value data that you can look at in the trend of a business. So in this example, I can see that this business is on an upward trend on their revenue. Back in October of 13, $2,896,000. Then $2,850,000. Then they finally got up to $2.9 million run rate. Then a $3 million run rate, $3.2 million. And then finally at a 3.4. So this is a business that is constantly building their value, in that term. But then revenue, like I said, is just an indicator. So let's look at gross margin. You can see what's even more important is gross margin dollars are increasing, and so they're getting, back here, they were at right around $2 million of gross margin, and so as each of those months come along, those margin dollars are filtering through and working. But what's even more important, this is a great example of how you see the power of direct LER. What they're doing, though, is they're getting more gross margin performance out of every dollar of labor spent. So in the end, out here, they're doing $4. So for the $586,000 that they spent in direct labor, they got $4.06 of gross margin for that, versus when they were back here in December of 13, they were doing 3.49. So when you look at that December, they were actually only doing net income as a percent of sales of 1.28%, and so they've actually been able to move and get all the way up to 5.6%. So they were able to climb out of being close to break even or zero, and just by improving, holding that direct labor constant. So you can see that direct labor, that dollar amount has stayed roughly the same, but they're getting more gross margin dollars for every dollar of labor spent. Same thing, when you look at operating expenses, you're seeing some growth there and some additional, spend. But you can see that the main thing is on their management LER, $3.52 of management LER against contribution margin of $17.92, versus when you go back and look at earlier, their management LER was at a low point here of 327, and so at that point, they were only doing 1.5 in contribution margin, and so that's a case where their management team wasn't producing enough up here, and so you've got to either change out some of those people, or you've got to get those people focused to is it driving more activity? Is it getting activity that you have more efficient? And in most cases, it's going to be some of both. So you can always see, and the other thing that we look at here is we also give you the net operating income as a percentage of gross margin. So if you're the kind of business like the distributor type business, you actually want to look at your business in that regard. You can quickly toggle, though, between rolling 12. One of the things we like is a rolling 3, and in the rolling 3 presentation, what's really neat there is if you've made recent changes in your business, you can see, how that productivity is really improved. And so you can see that this particular business, the bulk of their improvement came over the last 6 months, as they were in the 4s, even some 5s and 6s on direct labor efficiency in those early months. And then you can see back here was when they're really struggling. In the summer of 2013, they were down in the 2s, and it's just you got too much labor that you committed to that you're not getting enough activity out of, in that regard. So the rolling 3 is a great example of looking at a near term. Some businesses are built on, if you're a bi-weekly payroll company, a rolling 6 is another intermediate term, because I know that in every 6-month period, I've got the one extra payroll in every 6-month cycle. So you're trying to filter out the excuses. When I'm looking at rolling 12, that's my favorite, because rolling 12 represents, data that you're looking at that says there's 12 months, there's every season, there's every busy season, every slow season, every holiday. And that's why I really like rolling 12 as my highest value, but we've made it real easy for you to toggle between these. And the problem is you just can't get this presentation straight out of any accounting system, pretty much. I mean, there's a few high-end systems you might could custom write a report on that, but these, they don't produce them very well. Same thing on the balance sheet. We have a traditional balance sheet model that is fairly straightforward that you can look at. The cool thing down here is what the balance sheet shows you is your 2 key indicators of AR, DSO, day sales outstanding, and accounts receivable, looking at AP as a percentage of cost of goods sold, and then you look at core capital before taxes, and so it gives you your core capital calculation, what your 1-month target is, and what your 2-month target is, and what your surplus or shortage is, and what you got to drive for. So this business, you can see that they've been making progress of improving that. They were as high as 366 as a shortage, and now they're down to 199 because they've been able to produce profitability, and things are working much better now. And then let's see. So we also have another version of the balance sheet we call the simple numbers balance sheet. And I was playing around with this as a different way of looking at the balance sheet, of going, if I really look at a balance sheet as like a cash flow statement, what I would do is I would take all of my current assets and liabilities and come to what we call net working assets. And so we think this is actually an interesting view, because in reality, these things are going to kind of flop around. I mean, I may collect a receivable and just shifts from receivables to cash. That really doesn't change it. What you really need to be trying to do is improve the net working asset structure of your business so that this is a positive number and you're not relying on debt, to fund it. So same thing there, that it actually gives you the same analysis down below. We have several people that really kind of like that, as a function. If you're into looking at cash flows, same thing in terms of a traditional cash flow statement. The cool thing here is where most reports only give you cash flow on a monthly basis, we're actually showing you rolling 12, 6, 3, or monthly. And so it gives you an idea that if you're looking at rolling 12 cash flow, for example, and I'm looking out at here, I can see that my net cash flows from operations are significantly improving. And this is really kind of your big key, but you can also look to make sure that, hey, do I have a leak down here in my distributions where I'm taking distributions out in excess of what my free cash flow is. So these are quick and easy ways for people to get that. Quick little touch on the configuration page. It is really simple. Once you upload your data, this is your P&L that comes out of QuickBooks. All you got to do is pick one of these items and bucket it to our simple numbers, cloud over here of where it goes. And so we've only given you those bucket options that fit our model, and we've not found any situation to where some account in your QuickBooks P&L that doesn't fit. Same thing on the balance sheet. You got to take all your balance sheet accounts and and slide those over there. And then the cool part is you can set, your customize your settings. So if your core capital target, we have some businesses that, they want to make, if they're a highly seasonal business, maybe they want 3 or 4 months of core capital as their cash reserve. We've generally found 1 month, level 1 target is 1 month, level 2 target's 2 months, but if you want to make it higher than that, you can change the setting. If certain industries, for example, I would say our marketing clients, we get them to kind of target 15% as their break-even number. We like to see them at 10, 15, and 20 rather than 5, 10, and 15. If you're a custom programming business, programmers generally should be targeting about 20% pre-tax profit based on what their industry is doing now. But those are outliers. But if your business industry is an outlier, then set the targets accordingly. But we feel pretty confident in that 5, 10, and 15 is going to capture the bulk of the businesses. So you can basically just grab this and slide that scale, and make it, so if good is 20% and the warning level is at 10%, I can apply that to it, and so when I go back over to the overview, you can see that now that profitability is now in the red where it was in the yellow before. So pretty easy to make those settings changes and set your particular targets the way that they need to be. Revenue is just a hard-coded low and high. Gross margin, same thing. Direct LER, just input the values to make them what they are. So we really believe that, we've made it. We've tried to stay true to our concept of simple numbers. I mean, there's tons of other numbers that people may want to look at, as somewhat of an indicator, but we believe that when you have these numbers in play and you get these numbers right, everything else works. And so those other numbers are really just reflections of what these numbers really should be. So anyway, so with that, I'll come back over to the slide presentation and come back here. So as I said before, just go out to the simplenumbers.me website, and when you're ready to buy, use the discount code MILLS for a 10% discount off the monthly price. And if you are interested in if you feel like that it's a little overwhelming, we've made them very inexpensive consulting packages to help you map it, and even provide once we've got your data in there, we'll do a quick hour-and-a-half consulting session to just kind of go over your data once you have it in our format to help you truly understand, your data in a simpler format and learn how to manage, from that information. So, all right. So with that, Michael, I'll throw it back to you. And
okay, great. We do have some questions here, Greg, and I just had a quick question about that. Consulting, good. Once you've got your sorry? Can you hear me okay?
Yeah, go ahead.
Okay. So once you've got your numbers mapped, did you say that you guys would do a consultation to just analyze the numbers with the business owner to make sure that got it set up right and they've adjusted their sliders correctly?
Exactly. Yeah. So we'll do an hour-and-a-half session, and those prices are on the website. I don't have them committed to memory, but they're very inexpensive for people. When you go to sign up, you'll see the pricing, for the consulting packages. But we've had very good response from folks going, it really helped them see their data for the first time in a totally different way. And what we find is, here's the other thing that we see a lot of times. People think that their data is too messy. Well, what we found is our concept of simplifying the roll-up of everything, you'd be surprised that once you start looking at rolling 12 data on messy data, it actually starts to make sense, because I've filtered out kind of a month here and a month there, and I can look at it in that rolling 12 basis and see, okay, well, there is a pattern here, because this is all about pattern recognition. It's really all it is.
So one question I had from an attendee is they don't use QuickBooks, they use Sage 500. Is the Simple Numbers tool only available with QuickBooks?
It is right now, and so what I would recommend, two possibilities. They can go to the simplenumbers.me website, and there's some downloadable, there's a model that they could take a look at to see if they could custom program in the output to that model. Or what we do for most of our clients is we actually offer a custom model that we just take their data straight out of any accounting system, and we can create a custom model for them and help them see that data, and then we got it down to where we can do it so inexpensively that that's the only option for them at this point, though, is there's not an automated version for that.
Okay, and for them to contact you, let me just switch over to my screen, because I have a slide here. So you can probably the best number to contact would be Mike Maxon, who is Greg's partner, and his email address is mike.maxon@CRBCPA. That's Crabtree Row and Burger, PA.net. And you know what? I didn't put your phone number up here, Greg. What's your phone number? I apologize for that.
That's right. 256-704-0620.
256-704
0620.
0620. Okay, 256-704-0620. Another question here.
Well, I will say this. One of the things that's real easy about being named Crabtree is you kind of Google simple numbers Crabtree, it's pretty easy to find me.
Okay, simple numbers Crabtree.
That makes it pretty easy.
Okay.
That's right.
So if anybody else has questions, I have one more question here for you, Greg, before we leave. But if anybody has questions, just type them into the question bar or the chat bar on the GoToMeeting control panel, and Greg will answer them. I have a question here. Do you have access to my data? I'm concerned about other people other than my CPA seeing my numbers.
We do not have access to your detailed data. We have access to the rolled up version of the information. So we do have administrative access. So that is, I mean, you are granting us rights to be able to see it, although, I mean, we have no reason to look at it,
right?
Unless you're a client relationship to us. But we don't see the individual transaction information. It's all just the rolled up information into what the buckets show. So,
okay.
Yeah.
Okay. Any other questions? I'm not seeing any other questions. I think I've got. Let me just see if there's anywhere else on the system I'm seeing it. Okay, so let me just very briefly show you, if you're a Touchstone client and you're interested in getting access to the system, just open up your Touchstone account, go to your 4 key functions, click on your green button, whatever you've got this. It might say Finance and Admin. This is our actual Touchstone account here at Business Design Corporation. Yours might be running the business, or it might be some other name, because you can customize this quadrant. But if you select that quadrant, and if you go up to the Add from Process Library and select General Processes and scroll down to the S's, you'll see a system here called the Simple Numbers Profit Tool Master. Just put a check mark there, and I would probably pop that into your financial section, and then click Save, and it will download this process into your Touchstone account. Once it downloads the process, you can open it up, and there are work plans here for registering. Just remember that you can use the name Mills. This will give you can log in here and get a 15-day trial, and then if you decide to choose you use the code name MILLS, M-I-L-L-S, to get that discount for anybody that was registered today. But there are tools for mapping your QuickBooks file. There are tools for using the file. There's some different snapshots. I'm going to put today's video in, a link to today's video in this process so that you'll have access to this video that way too, because there's a lot of analysis that Greg did that I think was very helpful, and when he was describing that sample company, and I think watching that again would be very helpful once you have your own data up in the Simple Numbers tool. So that's how you would access this process, and you're welcome to call me at any time. You can call Mike at any time to get information, and again, the number for Crabtree, Rowe, and Berger, and to speak to either Mike or Greg is area code 256-704-0620. So with that, I think I will say thank you very much, everybody, for being here, and thank you, Greg, for your very, very in-depth presentation. I really appreciate you showing us that today. And is there anything you want to say before we just say goodbye?
Yeah, I really appreciate it, and I hope we get the opportunity to share some more on how to run profitable businesses. We think that's the real key to keeping the economy going and keeping people employed and making an impact in the world. So that's it's really kind of that passion that we have of helping entrepreneurs, really stay true to what their passion is. So.
Great. Well, thank you very much, Greg, for taking time out today. And just for everybody on the call, Greg's up in Whistler today, in Whistler in British Columbia, Canada. He's speaking to a large group up there on these topics. So you go out and have a great day and a successful presentation later today, Greg, and thank you again.
All right. Thank you. Appreciate it.
Okay, guys. Bye-bye, everybody.